Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out LuxAlgo. LuxAlgo has some of the best trading indicators and AI agent for backtesting used by over 15,000 traders, including myself. And I've covered many of their premium indicators in the past on this channel. And right now, if you sign up by using my link in the description below, you could get up to 20% off these powerful premium indicators. So go ahead and check out LuxAlgo. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. We're almost at 7,000 members, so I'll put a link to it in the description below as well. Now let's get right into today's video. So today, I want to talk about a very powerful trick you could potentially implement next time that you want to buy calls that could be very useful. So remember, everything I'm showing you here today is just an example, and I'm going to be using this stock here today, ticker symbol GM or General Motors, to take you guys through today's examples. So firstly, how does buying a call work? So let's go into the options here for GM. So here is the options button that we need to click to go to the options for the stock. So then here we are on the options for GM. And so when it comes to buying calls, we want to first make sure that we are on buy up here. And we also want to make sure that we are on call. So right now we're looking at all the calls for the stock that we could potentially buy expiring July 11th. So here's where you can modify your expiration date. But I'm just going to leave it as July 11th for today's examples. So let's say that I wanted to buy a call on GM at the $52 strike. So where is that call option? So remember, your strike price column is right here. So if you look under it, here is the $52 strike. So this would be the call option at the $52 strike. And if I click on it here, we can see the current price is going to be 80 cents, but that's per share. Remember, each contract controls 100 shares. So we need to multiply this by 100. That gives us about a cost of $79 to buy this call right now. Now remember, what does it actually mean to buy a call? So buying a call gives you the right, but not the obligation to purchase 100 shares at the strike price you selected anytime before expiration. And that's going to be if you exercise your option. But a lot of the times, people will just sell to close their option. So, if I buy this call, theoretically, I could exercise it anytime before expiration to purchase 100 shares of GM at the strike price I selected, $52 a share. Right now, it wouldn't make sense because the price for one share is actually less than $52. But theoretically, that's how exercising works. Or you can sell to close your call option. So when it comes to buying a call, remember, this is a bullish strategy. That means you generally want the price of the stock to go up. You think the price of the stock will go up and be higher than when you originally bought the call. And so we can again see over here, this would cost about $78 right now. So that's all I would have to put up. I would enter this for a debit, about $78. And we see our P&L chart over here. Now, I like to use option strat instead to visually take a look at what the trade might look like, what my profit or loss might be depending on the date, depending on the price of the stock, and so on. So let's head on over to option strat here. So I'll put a link to option strat in the description below. Really great options visualization tool. And if we take a look here, we can go to build. And under build and under basic here, you'll see long call. So we'll just go to long call here. So again, we're using GM for today's example, General Motors. I just used July 11th as my expiration date. And again, I said, let's say we wanted to buy a call at the $52 strike. So again, we'd be entering for a debit. As of right now, it would be about $78 to enter this trade. That's also going to be our max loss, whatever it is you paid to enter the trade. Max profit is infinite to the upside. So again, this is a bullish strategy. We want the price of the stock to go up. If you have the premium version of option strat, you can see what the chance of profit is according to option strat. So for this example, it would be about 33%. And then we have our break even here. So this means at expiration, I want the price of GM to be above 52.78 so that I make a profit here. Again, I want the price of the stock to go up. Now, what is the big problem with this? What if instead of the price going up for the stock, it goes the opposite way and it goes down? Right? Instead of going up, what happens if the price of the stock goes down? As you can see, you would lose everything you paid to enter the trade. So again, right now about $78 to enter this trade. If the price of the stock goes down instead, we would lose that entire amount, $78. So what if there were a way to do something similar to this, where we can buy a call, we can still have infinite upside potential, but if the price of the stock ends up going the opposite direction, ends up going down, we can still make money. So in other words, what if we could make money both ways doing something similar to this? So that's what I want to show you here today. So let's go back to Robinhood here. And I'm going to go ahead and I'm going to clear this call that we're buying. And so let's see an alternative here. And again, you can decide if this works for you or not. So the first thing we want to do here, right? Let's say you're bullish on GM, but there is a little bit of you that thinks there's a possibility it might go the opposite direction. So the first thing we'd want to do here then is first figure out if the stock ends up going down in price instead, what price will it go under? So if GM ends up going the opposite direction, if it ends up going down in price, what price do I believe it will go under? So let's just pretend I believe that if GM goes down in price, it'll go under $50 a share. Again, this is just an example here. So what I would do is I would start by selling a call at that strike price. So I'm going to switch over here to sell, and I'm going to find the $50 strike, which is right here. This is the call with the $50 strike. So I would start by selling a call here. Now remember, when you sell a call option, you're going to get paid a credit or a premium. How much for this example? As you can see here, about $218 I would get paid. I'm going to get a credit of $218 for selling this call option. So what we want to do next is we want to divide that value by 2. So that would give us, somewhere around 109 if we divided that by 2. So we have 109 now. So now what we want to do is we want to switch over to buy here. We're still going to stay on calls, but now we want to switch over to buy. Now we're going to buy our calls here. So what we want to do here next is you want to buy 2 calls now with a higher strike than the strike of the call that we're selling. Each call is going to have the same strike price, and each call needs to cost less than that number we came up with when we took the credit and divided it by 2. So if we do that again here, because the price is moving very quickly, right? Again, we're getting a credit of about 203. If we divide that by 2, we get about, 102. So I need to buy 2 calls here, same strike, and the call needs to cost less than 102. And so there's a few different options here, but I'm going to go with the one at the $52 strike. So notice here, one costs 77, so that's less than that 102 we came up with, so this should work here. And then I'm going to come up here, and again, remember, we want to buy 2 of these calls, not just one, so we need to come up here and go to custom, and for the calls we're buying, we want to do 2 here instead of 1. So we're buying 2 calls, and we're selling 1 call. We should be entering for a credit here. And if we take a look here, you can see already that we are going to be able to make money both ways with this strategy. But again, I like to use option strat to visually take a look at what this strategy would look like. So let's go to a new tab here on option strat, and let's go to build, and let's start with long call here. Let's go over to GM here, General Motors. Again, my expiration was July 11th here. So again, we started by saying, if you think the stock goes down in price, what stock do you think it will go under? Well, let's say, again, for this example, I think it'll go under 50. So we started by selling a call with that strike then here. And then we said, okay, take a look at the credit you're receiving, divide that by 2. Now we want to buy 2 calls. Each call will have the same strike price, and each call needs to cost less than that. The reason being that we need to enter for a credit here. And so we said, well, if we buy 2 calls at the $52 strike, that will actually work here. So as you can see, after doing that, we're still entering for a credit. So here is our strategy. Now let's compare it here to buying just a call. So here is, again, when we talked about just buying a regular call here. Entering for a debit, that's your max loss. You have max profit or infinite max profit to the upside. Chance of profit, 33% according to option strat, and your break even here. But again, you can only make money to the upside here. So now let's take a look at this new strategy. So we're still buying calls. We're buying 2 calls and we're selling 1 call. Now here you need to enter for a credit. Max loss, as you can see, has increased from, let's see, for this example, from 75 to 141, 140. But as you can see here, you still have infinite upside potential here. So your max profit is still infinite to the upside. So you can still continue to make money to the upside as long as GM continues to go up with this example here. Chance of profit, you can actually see here, has increased for this example. We went from 33 to 49%. And now as you can see, we have 2 break evens. Why? Because now, if the price of the stock goes down instead, we can also make money. So in other words, as long as GM goes above 53.43 or under 50.57, we will make money here. But we will still make more money to the upside. We still have that infinite upside potential here. So again, over here, we can only make money to the upside. If the price drops and goes down for whatever reason, we're going to lose everything we paid to enter this trade. But now here, if it goes to the downside enough, we can still make money here. And so to the downside, your potential profit is going to be limited to the credit you receive. So since here we're receiving a $51 credit, that's the most we can make if the stock goes down. But at least we're making money. We're not losing money. So as you can see with this strategy, we're still buying calls and we're able to make money both ways here. We still have that infinite upside potential, but now we can make money both ways here. Now, remember, you can close out of this trade at any point in time. So you don't have to wait until expiration to close out. And I'll put a link in the description below where I show you guys how to close out of any options trade. So again, if you're somebody that enjoys buying calls, but a lot of the time you're in the situation where the price of the stock ends up going the opposite direction, ends up dropping, right? You looking to buy calls again, you think there's a good probability the price will actually drop instead, this could be a potential solution here. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, a link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.